Your coworker made a fortune in real estate, while your friend just multiplied their savings in the stock market. So, if you live in a major Canadian city right now, what are you actually supposed to do with your money? We all grew up hearing this same advice at family dinners. Your parents and your uncle probably told you that buying a house is the only completely safe way to get ahead. This chart tracks the national average home price. Back in 1990, it sat at around $120,000. By today, it has climbed all the way up to $827,100, which explains exactly why older generations hold on to that belief so tightly. But during that exact same 30-year stretch, the stock market also went on a massive tear, delivering returns that matched and sometimes beat physical property. And today, we are dealing with a totally different math problem. A basic starter home in the GTA or Metro Vancouver currently costs more than a Hollywood mansion did 20 years ago. When you only look at how much a house went up in price, you completely ignore the carrying costs, the hidden risks, and the changing tax rules. That old napkin math is dangerously obsolete for today's market. There is one major government-backed mathematical advantage to physical property that you have to understand. It is called leverage. In Canada, you can buy a property with just 5% down, meaning a tiny slice of capital controls a massive asset. If that property goes up 10% in value, that gain is calculated on the full price, effectively doubling your original cash investment. You can legally borrow money to buy stocks too, but doing that on margin is incredibly volatile. If the market dips, your broker can instantly liquidate your entire portfolio. A bank will not force you to sell your house just because property values dropped on a Tuesday. Take a detached home in Calgary. If you put 20% down on a $450,000 house in 2015, the recent run-up past $1 million means you turned a $90,000 investment into well over $500,000 in equity. If it's an investment property, you're also collecting roughly 3 to 4% rental yield in major cities. You get the appreciation on the full asset value, plus monthly cash flow paying down the mortgage. That makes leverage an incredibly powerful wealth multiplier. But the math only works out if you actually have the tens of thousands of dollars required to get into the market safely without stretching yourself too thin. Of course, that's just the gross return. The reality of owning property comes with heavy carrying costs that eat away at those massive leverage gains. This waterfall chart breaks down the true cost. Property taxes on an average Toronto home chome $6,600 yearly. Maintenance takes 1 to 2% annually. Toronto land transfer taxes strip away $36,000. Realtor commissions take 3 to 5% when selling, drastically shrinking your net gain. Compare that drain to buying a broad market index ETF on an app like Wealthsimple. You pay 0 in trading commissions and maybe 0.2% a year in management fees. When you subtract the taxes, the constant repairs, and the closing fees, the true annualized return of physical real estate shrinks dramatically. The stock market, on the other hand, never needs a new roof. Canadian investors have one massive advantage over Americans when it comes to stocks: the tax-free savings account.
If you have been eligible since 2009, your lifetime contribution limit is $95,000. Every single dollar of growth inside that account is completely shielded from the CRA forever, and you can withdraw it at any time without paying a cent in income tax. This chart shows what happens if you max out that limit in an S&P 500 index fund. Over 20 years, historically, that $95,000 grows to roughly $640,000, and you keep all of it. The financial markets also offer immense liquidity. If you lose your job or face a sudden health issue, you can sell off $10,000 of your portfolio from your phone on a Tuesday morning. You cannot sell one bedroom of your condo to pay for an emergency. Physical property locks your cash up in concrete. If you still want the safety of real estate without the illiquidity or the midnight maintenance calls, there is a third path: real estate investment trusts, or REITs. REITs trade on the stock market and pool investor money to buy major assets like apartment buildings and commercial warehouses. You can buy them directly inside your TFSA, generating tax-free monthly income. Many top Canadian REITs are currently earning nearly double what they pay out to investors, providing a massive financial cushion compared to the negative cash flow that many amateur condo landlords are suffering through right now. So if you don't have a massive down payment sitting around, maxing out your registered accounts with index funds or REITs gives you total liquidity, zero maintenance, and a highly efficient path to compounding your wealth.
The actual winner between stocks and real estate depends entirely on your income, your starting capital, and your location. Let's look at a high-income earner making over $150,000 in a major, high-demand market like Metro Vancouver. For this investor, buying a primary residence remains a mathematically superior choice. In Canada, when you sell your principal residence, every dollar of profit is exempt from capital gains tax. That is an enormous government-gifted advantage that no regular brokerage account can replicate. Now consider a budget-conscious middle-class investor with $50,000 to $200,000 in savings, looking to grow their money safely. Stretching that capital for a minimum down payment on an investment property will likely leave you incredibly house-poor and vulnerable to interest rate spikes. You are far better off deploying that cash into stocks and REITs inside your TFSA and RRSP. Then there is the first-time buyer. With softened prices and longer 30-year amortizations, 2026 is actually presenting a legitimate entry window in many urban markets, but you have to run your own stress test. Right now, thousands of investors who bought pre-construction condos a few years ago are bleeding cash and desperately trying to offload them. Do not assume any property guarantees a profit. The single most damaging financial mistake you can make right now is sitting on the sidelines waiting to perfectly optimize your choice. Pick the asset class that aligns with your actual financial bandwidth and execute. The market won't wait for you to decide.